Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 20th of November. I'm Daniel Lam, your host for the podcast. For someone like me who is interested in technical analysis, there was a little bit of disappointment as there was yet another false breakout in the Hang Seng Index last week. Now, there were a few tailwinds on the back of the increasingly dovish environment in the US, the meeting between Presidents Biden and Xi, as well as reports on potentially further stimulus on the China property front. And the Hang Seng Index had a double breakout. It broke above the downward channel that was in place since the end of July, and it broke the lower lows and lower highs price pattern by going above the initial resistance level at 18,038. However, that gave way to some poor guidance on the earnings front. The most prominent one came from one of the bellwether companies in the Chinese internet space, where it had to shelve its spin-off plan for its cloud unit, specifically citing the roadblock caused by the chip export restriction to China that the US imposed. This shows the challenges China is facing in its quest to transform into a higher value-added economy. Moreover, the macro data last week showed that China's economic recovery remains under challenge. Removing the base effect distortion, month-on-month seasonally adjusted growth in retail sales slowed to 0.1% in October, from as high as 2.1% in the first quarter of this year. Now, our colleagues from Standard Chartered Global Research believes that the persistence in the housing market downturn continues to pose a major growth risk. So on a seasonally adjusted basis, their calculation shows that the 6-month moving average of housing floor space sold almost halved from May 2021 to October 2023. Thus, the ratio of total housing floor space under construction to 6-month moving average of housing sales rose sharply from 41 to 75 months worth of sales during this period. And in layman's term, that means too much supply versus demand, suggesting that new housing investment could fall further next year. So now, where to go from here? Well, the very low positioning is likely to support Chinese equities, with 17,000 a key support level in the Hang Seng Index. However, for a more sustained rally and a return of confidence in Chinese assets, investors would need to see more significant government support policies. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.